Howdy everyone, Greg Martin, the Entrepreneur's Banker here. And one of the things that I absolutely am most impressed with when I work with entrepreneurs is their gut. Now, a lot of entrepreneurs have grown their business from inception. And so they know all parts of their business in and out, like the back of their hand. And that is what allows their gut to be so finely tuned into what's going on in their business that they know when things are going really well or when things need to be improved. And sometimes that's a challenge for me as a banker. I don't have the 15, 20, 30 years of experience of being part of your company. So I don't know necessarily what my gut is telling me about your business. And I really can't translate that really well. And so sometimes when I have conversations, specifically when we talk about the working capital cycle and the fuel that your business needs in order to either sustain operations or to support growth, it's really hard for entrepreneurs' gut to be translated into the data that I need in order to perform the analysis and to help you. So today, we're going to take a stab at actually marrying the entrepreneur's gut feeling with data that's in your financials, so that when you go and you talk to someone and you say, hey, I need some help with an increased line of credit, or I need to raise a round of funding in order to support working capital, that you'll know exactly what that is. Because sometimes I have conversations with entrepreneurs and they're like, Greg, I'm about ready to take on 5 new jobs, and if 3 of them hit, I'm going to need more of a line of credit, or I'm going to need more capital in order to actually support those jobs. And so I said, okay, great. Well, tell me how much you need. You've got a $300,000 line now. Are we talking a $600,000 line? Or are we talking $1 million line? What is it? And to be able to say, okay, here's what it is. And a lot of entrepreneurs can't provide me the data in order to that I need to do the analysis. So today we're gonna walk through that. But before we get started, if you have not received the working capital workbook that I designed specifically for this course, that allows you to take notes with each one of the lessons that we're going to go through, and also to be able to have the interactive charts and the graphs so that you can plug your information into the system and understand your working capital cycle better, then send me an email at greg@theentrepreneursbanker.com. I'd be more than happy to send that to you. So just as a quick recap of last week's episode, and if you haven't had a chance to check out last week's episode, I encourage you to hit pause now and go back, because that really lays the foundation for what we're going to be talking about. But as a quick review of that, let's talk about what actually the working capital cycle is. The working capital cycle is the cycle that your business goes through, and it starts when you receive an order from your customer. Let's just call that day 0. Now, let's say that you immediately go out and you order the materials that it takes in order to produce whatever you do, and you get it the next day. And then you manufacture those materials and you turn them into whatever the product or service. In this example, we talked about a custom shipping container, and say that it takes 15 days in order to do that. Well, the next day, as soon as it's done and it's built, you're going to go ahead and you're going to deliver that container to your customer, and you're going to immediately invoice them. Now, the time that you have held onto the materials until the time that you no longer have those materials, when you convert that inventory into accounts receivable, that's a specific period. And that'll be important. We'll talk about that a little bit later. So after you've delivered the materials to your customer, now you have to pay for those materials. Now, you were lucky in that you actually got 30-day terms from when you received the materials in order for you to pay. But on day 30, cash has to go out. It flows out of your business because it has to go to your suppliers. But you don't receive cash from your customers for 30 days after you've received after you delivered everything and the customers have received their invoice. So you delivered on day 16. On day 45, cash is going to come into your business. So this, in a nutshell, is your working capital cycle. And the difference, obviously, we can see that there's a problem between day 30 when cash flows out of your business, and day 45 when cash flows into your business. And that is what we are going to call the working capital need. Now, you can tell that this cycle is made up of three specific holding periods. The first one, the holding period, is when you receive inventory and you hold on to it until you no longer have that inventory because it has been delivered to your customer. And in essence, that asset has been transformed from inventory into accounts receivable. Now, we talked about before, your material supplier, they were really generous to you and they provided you terms. So they delivered you the inventory that you needed, but you didn't have to pay them for 30 days. So that's called your payment period, or in this example is net 30. But then you have your collection period. And the collection period is the time when you invoice the customer until they have time to actually pay you back. That's the collection period. And again, in this example, it's net 30. You can see here that the working capital cycle starts when you get an order from your customer, and then it goes all the way around until you get that cash into your business. Now, along the way, you have to actually pay cash out, whether that be to your suppliers or to your employees or to pay rent or utilities or whatever. But it all starts with customer order, ends with cash. And then you use that cash in order to fulfill the next customer order, and it just keeps going, and the vicious cycle continues. But again, you can see why. This is why I call working capital as the fuel that supports or drives the engine of your business in order to generate profit. So that working capital cycle is made up of each one of those three periods: the holding period, the payment period, and the collection period. And we're going to talk about each one of those, and we're going to specifically go through as to how you can actually quantify them, how you can to put a number to that. And we're going to do that in a couple different ways. We're going to do it from a traditional standpoint, and most banks consider traditional working capital as just the expenses that deal with generating your gross profit. So all of your costs of goods sold. But the reality is that you still have to make rent payments. You still have to pay your non-cost of good employees, like your salespeople, your overhead. You still have to pay for insurance. You still have to pay for marketing. You have to pay for a whole lot of other things that aren't necessarily associated with the actual cost of goods sold or the production of the good or service. So we're going to look at it both from a traditional working capital cycle, but then we're also going to do a modified working capital cycle. And while we are going to spend the majority of the time in today's discussion about a product company or a company that has to manage inventory balances, at the end, I'm going to go through this analysis, and we're going to talk about a service company or a company that doesn't have inventory to manage. Maybe you're like a software provider, or or some other type of an attorney, a doctor, or something. It's something you really don't have a lot of inventory to manage. So we're going to talk about both of those. So if you are a service-based company, this is still very, very critical to you, and we'll talk about that at the end. So let's jump right in and let's talk about the holding period. And the holding period is the period of time where you actually hold on to inventory or materials in your business. So the holding period obviously starts once you take possession of that inventory, and it ends when you have transitioned that inventory into something that your customer wants, and you send it to your customer, so you no longer have possession of that. And in essence, that asset, that inventory asset, has then been converted into an accounts receivable. So let's think about it this way. In the example that we talked about, we were talking about a customized crate. So the lumber, when they got the lumber in from their supplier, and they held on to it for the 15 days because that's how long it took them to convert sticks of lumber into the customized crate. Well, that 15 days was the holding period. And then after that 15 days, that lumber, now in the form of a specialized crate, was sent to the customer, And the asset, so you no longer have that, but instead of having an asset of inventory, you now have an accounts receivable, which obviously should be higher because the inventory, the value of that inventory is just what you paid for it. And hopefully you're not giving an accounts receivable, or you're not giving an invoice just what you paid for. You got to have some margin in there to actually operate. So the equation that we're going to use in order to actually calculate the holding period, also known as inventory days on hand, is pretty simple. You just look on your balance sheet and you take your inventory and you divide it by your cost of goods sold, and then you multiply that by 365. Let's look at an example. So we're looking here at Strong Corporation, and you should be familiar with this if you took a look at the first lesson. But let's talk about inventory days on hand. Again, this is the holding period. This is the period that you actually hold inventory on your books. And so simply, in order to calculate this, we simply take the inventory amount, that's $150,000, divide it by the cost of goods sold, that's in this point $2.74 million, and then we multiply that by 365. You can see here that's 19.98 days. Or another way to think about this is every 19.98 days, the entire inventory is turned by this company, because that's how long it takes to work through the $150,000. Now, as we said, that may be traditionally how a bank looks at working capital analysis, but that's not the whole picture, because you, throughout that 19.98 days, you have to pay your people, you have to pay your rent, you have other operational costs. So what I'm going to talk through throughout the entire spectrum of this course is what I'm calling the modified working capital analysis. And in order to do that, using the holding period or inventory days on hand, it's simply, we're going to take the inventory, the $150,000, and then instead of just dividing it just by the cost of goods sold, we're going to add the cost of goods sold and the operating expenses. We're going to add those together in the denominator, because you have to pay those things. It's not like you can go to your landlord and be like, hey, I'll pay you whenever I get paid from my customers. That's just not going to work. And so in order to do the modified working capital analysis, or the modified inventory days on hand, is $150,000 divided by the 2.74 plus the 730,000, and that means that your inventory days on hand is 15.77. Now, think about this, okay? Is obviously lower because you have more costs. That means you have to turn that inventory at a faster rate. So we're going to jump over the payment period and just say, we'll come right back to that. But let's talk about the collection period. So we have the inventory and we send it off to our customers, and we have the receivables back. And now our asset went from inventory into the accounts receivable. So let's talk about the collection period. The collection period is the time that you give your customer from the time that you invoice them until cash actually comes into your business. So obviously you want to keep this as short as possible, because cash is king, and the amount of cash that you have, if you have it on your balance sheet, makes you much more flexible. However, the reality of it is that a lot of companies don't do business unless you extend them terms. And so you have to learn how to manage the accounts receivable. Now, the accounts receivable, or the collection period, or the accounts receivable days on hand, that equation is your accounts receivable divided by your total revenue times 365 days. Now think about that. So what is the so with your inventory, that is accounted for on your financial statements as part of your cost of goods sold. So that's why inventory, your holding period, is inventory divided by cost of goods sold. Your receivable is brought into your income statement by revenue, because you convert receivables into revenue. So that's why The collection period is accounts receivable divided by revenue times 365. Let's look at the example. Here we are back looking at Strong Corporation. Our accounts receivable days on hand is simply our accounts receivable divided by total sales, in this point, 3.8 million, times 365. So accounts receivable divided by the 3.8 million times 365. That equals 16.97. So another way to look at it is that every 16.97 days, your accounts receivable has been turned completely. So that's really good when you look at it from that standpoint. Now, just like we talked about before with the inventory days on hand, that using just the cost of goods sold doesn't necessarily show the whole picture. But you'll notice in the modified working capital analysis, the accounts receivable is the same, 16.97 and 16.97. Well, why is that? Well, that's because both of them are dealing just with your accounts receivable balance and just your total sales. Now, it would be fantastic if you were in a business that you could get all the inventory and get all the supplies that you needed and not have to pay for it. But that's not reality. The reality is that you buy things from other vendors. You have your secret sauce and your special way of converting whatever that is into a product or a good or service that your customers want, and then you convert that. But you still have to pay for that raw material. And so that's where we talk about the payment period or the accounts payable days on hand. And so what we're going to do in order to have the equation for the AP or accounts payable days on hand is that we're going to take your AP, your accounts payable, and divide it by your cost of goods sold times 365. Or, as we're looking at the modified, is that you're going to be your accounts payable divided by your cost of goods sold plus your operating expenses, and then that answer multiplied by 365. Let's look at the example. So accounts payable days on hand, as we talked about, very simple calculation. We are taking your current liability, your accounts payable, in this sense, that's the only current liability, divided by your cost of goods sold, 2.7 million, and then multiplying that by 365. So it's really simple. Now, for the modified working capital analysis, we have the accounts payable divided by 2.7 million plus the 730,000 of operation expenses, and then that multiplied by 365. So I hope that as we walk through this, I know that we went through it very, very quickly, but it's very simple to understand how your inventory, your holding period, your AR, your collection period, and your AP, or accounts payable, or your payment period, all come together in order to generate or in order to flesh out your working capital cycle. Okay, so we can see how the holding period, the collection period, and the payment period all make up your working capital cycle. But like we talked about before at the very beginning, there may be a time when cash has to flow out of your business before it actually comes into your business, and that's your working capital need. So how do you actually determine what your working capital need is? I'm so glad you asked. It's really, you've actually done all of the hard work already in calculating the holding period, the collection period, and the payment period. So we have broken down those three periods into days on hand, or to have a common denominator, a common methodology throughout that. So the first step is to determine the number of days that your working capital need has. In order to do that, you simply take your inventory days on hand and you add your collection days on hand, or your accounts receivable days on hand, and then you subtract out your accounts payable days on hand. Remember, you've got your inventory that's converted into AR, so those are assets. And so you have that, but then that's money coming into your business, but then you have to pay for that inventory, that's money going out. So inventory days on hand plus accounts receivable days on hand minus accounts payable days on hand, that gives you how many days of working capital need you have. So what do you do with it? That's great. So you simply take that and you multiply that by the daily amount of cost of goods sold. Let's go back and let's show you an example. I think it'll make a lot more sense that way. 3, 2, 1. Okay, so here is our working capital need as far as how many days we need. So we simply take the inventory days on hand, add it to the accounts receivable days on hand, and subtract the accounts payable days on hand. Very, very simple to do. Inventory plus AR minus AP. So that gives us 26.96 days. And in this example, for the traditional working capital cycle, that translates into a working capital need of $202,000. So how do we determine that? The first thing we do is we need to determine the daily cost of goods sold. That's just simply taking all of your cost of goods sold and then dividing it by 365, and then that tells you what you need. In this instance, you've got $2.74 million in your total cost of goods sold. And so you simply divide that by 365. That means that you've got $7,500 every single day in your cost of goods sold. So you simply say, I have a working capital need of 26 days, and then I multiply that by the 7,500, and that gets you the 202,000, your working capital need. But as we said time and time again, that does not say the whole picture, because you still have to pay all of those other operational costs. And so in order to look at the modified working capital analysis, what we're going to do is we're going to take your inventory days on hand, add your accounts receivable days on hand, subtract the accounts payable days on hand. Same thing, same type of equation as we did before. But when we're determining the actual working capital need, then what we're going to do is we're going to multiply the 24.85 times, we've got the 2.7 million plus the 735,000. So again, in this instance, we've got 2.74 million in annual cost of goods sold and $732,000 in other operational costs. And you divide that by 365, or you've got about $9,500 a day or so in order to run your business. So every day that you wake up, or every day that this entrepreneur wakes up, it takes $9,500 in order to actually run the business. And if we need 25 days, 24.85 days of a working capital need at $9,500 a pop, then that means that our modified working capital analysis, I just noticed a little typo, modified working capital need is $237,000. And to me, this represents a more accurate understanding of your working capital need in order to operate your business. Hopefully, this will allow you to transform that gut feeling that you have into actual tangible numbers that you can use in order to plan and support your growth goals and your what you're facing. But what about if you're a service company? Now, what if you're a service company and you have the benefit of not having to worry about any type of inventory management or any type of inventory planning or anything like that? Well, let's look at that. Let's look at this, but real quickly, it's the same exact information, but you simply don't have to worry about any of the inventory days on hand. And what you'll see is that information, it's simply taking whatever that inventory balance is and subtracting it out. All right, let's go back one last time. You can see here in the Service Corporation, we've got the balance sheet and the income statement. Everything is identical to the previous one that we looked at, with the exception of zero inventory. So let's see how that impacts your working capital. We'll start by looking at the traditional working capital analysis. Obviously, your inventory days on hand is 0 because you don't have anything to manage. But your accounts receivable days on hand, well, that's the same exact thing. We've got your accounts receivable divided by your total sales by 365. That gives you a AR days on hand of 16.97. AP days on hand, same thing as we've done before. It's the accounts payable divided by the cost of goods sold, and then that multiplied by 365. In order to determine your working capital need, you have your inventory days on hand, which is 0, plus your accounts payable days on hand, which is 16.97, minus your accounts payable of 9.99. So your working capital need in this situation is 6.97. We take the 6.97 and then we multiply it by the cost of goods sold divided by 365. Again, remember, we're looking for the daily cost of goods sold, but that doesn't necessarily tell the entire story. So looking very quickly at the modified days on hand, you can see how it is impacted and how it's changed. Now think about this for a second. So if you're a company that doesn't have to worry about investing into inventory, then obviously you don't need to have as much working capital. You don't need to have as much cash injected into your business because all of your assets are in the cash and the accounts receivable. You don't have to worry about the inventory. So that's why your working capital need is less than if you have a company that you have to manage inventory. Okay, 2 final points before we wrap up for today. The magic of this analysis obviously happens when you have accrual-based financial statements. Because if you don't have accrual-based financial statements, you don't account for your receivables or your payables. You may account for your inventory, but maybe not. So having accrual-based financial statements really helps you understand your working capital cycle. Now, if you don't have that, if you're cash-based, then what I'd recommend that you do is you take either your cost of goods sold from a traditional standpoint, or cost of goods sold plus your total operating expenses, and figure out what you need every single day in order to operate. And then you multiply that by 60. And the second thing that I want to point out is that this is just a point in time analysis. So if you were to look at your company on January 1st and then look at your company on December 31st and say, okay, well, here are the 2 data points, your working capital need might just be, slightly up or slightly down. Or depending upon the seasonality of your business, you might have a huge working capital need at those 2 points in time. But my point is that you don't really know what your working capital need is throughout the entire year unless you perform this type of analysis on a monthly basis. So I've actually developed a monthly working capital cycle picture that you can look at. And if you send me an email to greg@theentrepreneursbanker.com, then I'd be more than happy to send that to you along with a bonus video of walking through how you do that analysis so that you can understand what your entire year's worth of working capital need is, because you might have a huge spike in the summer months that you need to have working capital set aside to be able to support that. But in the spring and the fall, that kind of dies down. So understanding your working capital need throughout the entire year is super critical. Well, that's it for today. I hope that this brought immense value to you and helped you to marry a little bit of your gut feeling with actual data so that you can have tangible numbers for you to be able to help you grow and expand your business as you're planning out your working capital need. So I ask you to join us next week when we talk about the impacts on your working capital and your working capital cycle and your working capital need based upon 2 critical factors. 1, the growth of your company, and 2, managerial changes or managerial decisions, whether that be extending more accounts receivable terms, maybe that's bringing on more people, maybe that's investing into machinery and equipment that makes you more efficient. But all of those things have an impact on your working capital cycle. And so before you make those decisions, you need at least to be aware of those things. Finally, it would mean the world to me if you hit like on this video, or you'd share this video with an entrepreneur that you think that would benefit from it. If you have not received the Working Capital Workbook, please email me at greg@theentrepreneurbanker.com, and I'd be more than happy to send you the workbook. And then if you're interested in getting that bonus episode of how to manage and how to work through your monthly working capital cycle, I'd be more than happy to send that to you as well. Until next week, this is Greg Martin, the Entrepreneur's Banker, thanking you so much for joining me. I wish you peace, I wish you success, and I wish you a wonderful week. Thank you.